Hello, welcome to Finance 225, International Finance Management, offered by Harper College. You're either taking me in an online class or a face-to-face class, and this is part of our summarization. You've already discussed some of this materials within the discussion board or in the lecture in the classroom. Remember, you're to print out my concept maps that you find in Blackboard Course Management System. You are to read the book. The author has excellent examples for each one, and as you're reading, write your notes within my concept maps. You have it to the second tier, usually 2 pages in a PDF file, so everyone can open it up, could write it in, and then after the lecture and everything else, now you're looking at this as summarization. What did we discuss? So if you're just picking this up off of the YouTube and haven't signed up for the class, please sign up for the class. Ask for Dr. George Mochocki, Finance 225, or some other classes I'm teaching at Harper or College of Lake County. This is how I pay off my student loans, so ask for me so then I could have students take the classes and then we all benefit. But otherwise, so this way may not much sense to you because we already covered the material. I'm underneath the assumption that you understand the basic fundamentals. And this is just to as a summarization. Okay, so this chapter here we're going to be talking about direct foreign investment. Okay, so open up your concept maps. You already read it. You've already been in the classroom, and we're going to talk about what motivates corporation, MNC, multinational organizations or companies, medium to even small ones that want to start going into the international aspect, open up either a distribution plan, open up another facility. Then franchising is one way that the franchisor benefits because all the burden is on the franchisee to find the land and everything else. He or she just has the rights to utilize the franchisor's logo and all the marketing material and the name recognition that comes into that. So this is just another way. Why would I want to open up my own facility in another location? No similar than for your own personal. Why would I want to open up, buy my own summer cottage versus renting a summer cottage, let's say in Canada or in Mexico? I'm just using the states here, the countries next to us, because remember, to direct foreign investment to be considered a truly multinational organization, I have to have a operation outside of the United States or outside of the parent. And Canada is real close to us, up this way north, or Mexico if you're going down south, the southern border of the United States. So why not right away? And you see CDW basically went into Canada, and now they're a multinational organization. Okay, so let's look at this. So this is a shorter chapter. I try to keep it underneath an hour. And remember, they've got some YouTubes in here, there's some videos. This one's not too bad. This is about foreign direct investments, and it all ties in with the other previous chapters we had. Okay, so what motivates individuals to actually open up a facility overseas? And that could be because the distribution is closer, the manufacturing is closer, or because of the regulation. Remember, all the different factors that affect my decisions for opening up overseas or operating in a global economy. Which by its default, most companies have no choice. You have to operate in global, either buying your merchandise from overseas because you have a better cost, maybe many times even a better quality, or you could sell your goods overseas because you have the better cost or better quality depending on the exchange rate and the value of the currency that you're denominating, to transfer it into to utilize it for your final transactions. Okay, so revenue-related motives, those are good ones. And here are some, let me just close all these. Boy, we got a lot of them in the revenue-related. Get your pencils ready, class. We're doing good. Okay, so attract new source of demand. That makes kind of sense. MMCs commonly pursued direct foreign investments in countries experiencing economic growth. That's why you see a lot of activity going in China. Benefit from increased demand of products and services. Plus, you already know the rules and regulations, and you are part of the decision-making process when you're already in there. So you understand how to logistically operate your business within that confinement. Then you now have to understand your customer base, but you also have to understand the regulatory and the legal aspect of where you open up your business. The tax and everything else on there. Okay, enter profitable market. Here's what's happening. You're coming in there with similar industries. I'm already in there. There's somebody else that's doing pretty good, and I say, hey, I've got something similar. All I got to do is adjust my product just a little bit. If I do it here, I'll have my cost saving in a particular country. Decide to sell its own products in those markets. So then I eliminate the distribution channel. Anything I could do that control the distribution channel or bring it closer to be a self-sustained operation, just a dollar attached to it, a dollar attached to it, how much savings at the end. And not only savings for the subsidiary, but overall you have to look, does this saving make sense for the overall strategic plan of the MMC, where I'm looking at its value. That's the bottom line, as a corporation. And look at all these other subsidiaries as departments, if you're looking at it from a corporate structure, but now you're looking at it global. Okay? Exploit monopolistic advantages. Firms, but let me make this just a little bit bigger for you. Hang on. I apologize. Oh, 200. There we go. Gee, now I can even see it without my glasses. Okay, exploit monopolistic advantages. Firms possessing resources or skills not available to competing firms may attempt to exploit it internationally. So I got something else that's a monopoly, and I've got this only one way. Maybe I could go. And I see Israel do a lot of things with security. For everything else, they're always trying to destroy Israel. That's not my, I'm not going any kind of political stand here, but they have to take security very cautiously. So they probably have the best on, they do profiling, they do a lot of different things before they actually see if that individual is a potential person to pull off to the side and discuss their travel plans. Hey, I'm being pretty diplomatic here, all right? Okay, so react to trade restrictions, remember, because they says you can't have an import, so I open up the facilities here so that I don't have to worry about quotas, because I'm actually building it in the home country. And this way I become part of that establishment of that culture as it's growing up. Okay, may diversify and direct foreign investment to circumvent trade barriers. Diversify internationally. It's a big one by diversifying sales. You like to be known internationally, and possibly even production internationally. A firm can make its net cash flows less viable. All right, volatility. It's not as explosive, for lack of better words. Okay, cost-related motives. Okay, we got a whole bunch of there, and cost-related motives. Okay. Let me just see what we have here. And remember, you should have already read this. And now this is just as your summarization. Okay, cost-related motives. Fully benefit for economies of scale. You like it, not the more I'm billion, the more I could buy a larger quantity from that host country, the better the pricing I will get. Remember, there's a lot of other pricing than just economies of scale. Okay, lower average cost per unit is what I'm looking at, it resulting from increased production. Similar when you go into Costco, Sam's, and you're looking at, I got 24 cans for so much, I got 27 cans for so much. I'm looking at what's the price per unit. That gives me a good idea. Okay. It already breaks it up per unit. Am I saving by buying it larger, or I'm not? Use of foreign factors of production. Remember, when you look at for the economics, foreign factors of production, and labor and land is the two biggest ones. Technology and everything else. I can bring in my own because it's a smaller percentage. Can vary dramatically among countries. Okay, and Africa's going to Africa. I got a lot of individuals, a lot of people, a lot of land, but they don't have the infrastructure. They don't have the power plants, and they have the technology or the educational levels, which the experience to work some of the high-end computers. But I could utilize them for the low end and bring up that culture or that the demographic to meet my needs by developing them in a step-by-step approach. Okay? Use foreign raw materials. You see China doing that all over. Why utilize us? The U.S. is the same thing. We're sitting a lot of oil reserve, but why not use somebody else's? So when we use all theirs up, we're the ones in there. I don't know if that's a strategic plan of the U.S. or just they didn't think about it because basically cost. Okay, develop the product in the country where the raw materials are located. And you see China, what they call sovereign wealth, if you're taking that for any other kind of national business. Use foreign technology because I'm already there. And I say that's the thing people are going to try to stop with Israel, but Israel, whether you like it or not, comes up with most of the most innovations and new technologies out there for cancer, for medical treatment, and for a lot of other things. It just happens to be, it works out that way with that. So they already have that edge. So people don't want to really cut them off from that because they are one of the stronger ones and some of the technological advances. But you have to work within their organization or within their culture or the country for some of them. Okay, react to exchange rate movements. This is the biggest one. We've been talking about the other chapters. Perceive that foreign currency is undervalued. It means eventually it's going to be worth more, so I could buy more depending on my strategies. I'm importing or exporting. The firm may consider direct foreign investment in the country because now I'll have more money to buy the equipment. Remember, it's all looking at dollars. How much is going to cost me here? How much is going to cost me here? How much if I convert? How much saving? The bottom line is, am I making money, or which money is breaking even, or which money I have a higher profitability? Outlay should be relatively low. Comparing benefits among direct foreign countries. And I got an exhibit here, so you look at it, that attract new sources, and you could read this on your own. I'll just open up like this, stop it, read it. Exploit monopolistic advantages, react to trade restrictions, establish a subsidiary in the market with offer, diversify international, establish everything we've talked about, cost-related, fully benefit economies, establish a subsidiary in a new market that could sell and produce elsewhere and allow for increased production. So I can make it here, not only in that market, I could even ship it with the shipping costs and still having a comparable advantage and sell it someplace else. Raw materials, everything we talked about. So this is the summary, and a disadvantage is a disadvantage of direct foreign investment, DFI. Remember, there's so many acronyms. I hate to use all the acronyms, but it makes it easier here. So you have it here. You could look at it. Okay. MMCs, that's the one that's always out there. Multinational corporations can compare benefits to direct foreign investments among countries and U.S. direct foreign investment to achieve those benefits. Okay, so what I'm finding different countries, how could I offset one over the other? Okay, measuring the benefits. Now I also have an exhibit on here. Identify the motives, so you could read the capital budgeting, international corporate control. I can control international within the firm of potential corporate targets in foreign countries that could be acquired. Because I'm looking at strategically as the the whole global, which markets, which area makes sense for me. Asian market, Asia's devaluing, playing a little bit. Let's go to European Union to get the Greece settled. The euro's coming around there. And I have so much currency in the euro. Is it to my advantage now to keep it, to utilize it, to bring it back, or to sell it? Or in this case, what we're talking, do I just buy property since I already had the money in that denomination? Country risk analysis. So if you figure, is Greece going to be good? A lot of people are going to start investing. Are they going to play the same thing in 2 years when it comes up, or sooner, because the people are going to be still upset because they're actually going to go into a depression for the next 2 years? But that's someplace else. You're going to have very little disposable income. But I could get cheaper labor, or what else could I get? What other kind of products do they have there? What could I make something out of it in that turn? Because they're at the bottom, they can't get any worse. So, and they got the IMF, International Monetary Fund, plus Central Bank of Europe, European Central Bank, for lack of better words, is controlling that. They're helping them out. Okay, apply multinational capital budgeting process to compare benefits, cost of international project, which one goes, which one doesn't, which one has a higher return, which one has a quicker payback, which one makes more sense for the whole strategic of the MMC. Not the local thing, I have to look at the local, but the local is just part of the MMC. Will that give me value in the short term or the long term, depending on the strategic plan, and different cash flows and inflows that I'm looking at, different exchange rate, depending on how large and how many countries I'm operating in. Also requires an assessment of cost of capital, debt financing possible. Do I take a loan out? Do I sell shares, or do I issue a bond? What is the best thing? Which and where do I issue it? In which market? With exchange rates? Where would I want to do it? And then how do I hedge against that? Because I'm doing it in the future. Okay. All right, so that took care of everything else that we wanted here, motives for direct foreign investments. The next one here is benefits of international diversification. Okay, so we're going to, and you always said diversification, and this is the whole thing when you look at the hedging and everything else we're talking, this whole international is buying, hedging, keeping money, opening up different markets, transferring money, using to get my advantage, or use get the most out of that currency, so I get that highest yield like the farmer. How do I put it on steroids, for lack of better words? Okay, select foreign projects whose performance levels are not highly correlated over time. Okay, and here's an example. So I have to, and here's a formula. So if I'm looking at this, what do I have here? I'm looking at existing business if located in the United States, if located in the United Kingdom, characteristics of proposed project, investment after taxes, so standard deviation. Okay, so I'm looking at that. Take a look at, and after you're looking at which one makes sense for me to open up and where do I want to open up. Annual return on investment after taxes. So far, United States, United Kingdom, does existing business. Either one, if I locate existing business, it doesn't tell me where I'm at. You know what I mean? Okay. You have to look at it in the book. It probably has that in there. And here's your the formula. Remember, you already have that in your scientific calculator, your financial calculator. You just plug it in, and you're all done. It's an economic formula. Okay, diversification, analysis of international products. You compare portfolios among frontier efficient products. I'm comparing them. So I'm looking at what's going on. Frontier product, which one is the highest ones? Which ones are at risk? Return analysis internationals. This is where I want to shoot at. Okay, comparing frontiers among MMC. Again, now I'm looking at this with efficient frontier project for multi-product, efficient frontier project portfolio for MSC that sells steels in the European Union. So you have different lines that you have to look at. What's the risk and the return? Which one am I going to do? And what is the risk? And when I'm looking at the risk, the higher the return I'm expecting. So I could charge a higher thing, but the higher that I could lose the money. That's why you do the hedging. That's why you buy future contracts or forwards. Okay, diversification among countries, and country stocks market value reflects the expectation of business opportunities, economic growth, shows how the stock market values various countries. So you got Brazil, so you can look at different stock markets, at the year, when it went down, let's see, comparison economic growth, suffer. Some of them didn't do as bad as other ones did. There's the U.S., United States. Okay, we're still underneath there. All right? Not too bad. So which countries? None of them did too good. And the ones they listed. So that kind of good when you're going to look at some kind of a report, put them all bad. So you say, hey, don't look that bad. You don't want to put them next to a good one. All right, good statistics, good marketing. All right, let's see. So now where do we go? Let's move on over to 4. And we should be done in a little bit here. Or 3. What the heck? Did I lose it? Okay. I'll put this back up in here. What did I do? Let me just close this off. Hang on a second. I got it on. Oh, I got this one. I got to close off. Okay. All right. Let's go to 3, and then we're going to talk about the host government's views of direct foreign investment. How's the government looking at it? Okay. Incentives to encourage. China wants more, a lot of them, but do I want to be underneath that restriction of the government? Remember when in Rome, you got to be like with the Romans. Okay, so the ideal direct foreign investment solves problems such as unemployment for the host country, lack of technology while taking business away from local firms. So I'm bringing them in here, I'm hanging them in. And you see a lot of times when we have foreign imports and they're going to put like a revenue, protective revenue on that to sustain that, why not open up the operation here? It's good PR, brings people in, I get all kind of discounts, I don't have to worry about this, and I'm building it here. And then I'm just bringing the money out. But when do I bring the money out? Okay, government imposed condition to engage in direct foreign investments. Governments are particularly willing to offer incentives for direct foreign investments. You see, Cuba's opened up now since we got a relationship. Businesses are already lining up. There's a lot of people out there hungry. And what you're looking at, if you look at a lot of cars there, they got all these old cars there. Not with all the rust and everything else. It could be a collector's item here. They got them there. Now I can start shipping, give them new cars with all the technology, and take the older ones and make some money on that. Okay, it's not an antique. That's an antique. It's an antique car. Okay, governments are particularly willing to offer incentives for direct foreign investments, and Cuba to bring business in there, will result in employment for local citizens and increase in technology. Remember, it's a two-edged sword. And government increases technology. Now people look outside to see what's going on. And you can look at North Korea, why they're doing a lot of that. They don't want people to see what's out there because then they may rebel because they figure, hey, wait, we're not really doing that good here like they said. The rest of the world doing excellent. We're just starving for no reason. A little political in there. But if North Korea comes in there's a lot of people. I could start coming into a business, the low labor. Same thing that's happening in Cuba. You never know. So that's going to be an advantage to South Korea if there is a unification, similar to what happened to Germany when they unified back in there. Okay? And okay, and so I'm looking more at the unification being more in for a capitalistic system because that's where China, everyone's going to capitalistic system, or market system for lack of better words. You know, you can still could do contain, and like we've learned before, indirectly the government could contain some of the movements. Okay, okay. So here's some barriers. I got a class in a little bit, but I'm just looking at that. Barriers to direct foreign investments, protective barriers. Agencies may prevent MMCs from acquiring companies if they believe employees will be laid off. Remember, this is the government may do that. Red tape barriers. Geez, red tape. Yes, we're not too bad, but we're pretty bad on that. Procedure and documentary requirements. If I'm looking at what's happening with the SOX accounting because of all that corruption that happened at the higher end, and so now when I'm looking at this, the SOX passage of all the accounting rules and procedures that's affecting the small, a lot of red tape, and now you're getting with the EPA coming in, a lot more red tape, and now you're going with Obamacare. I have to do all this, a lot of red tape. I would spend more time in red tape than actually selling the business, especially from a small business to medium business perspective. But that's going to be a cost, a larger organization. So, okay, how much does that cost company? Am I going to have a higher return? Once I understand the cost, I can minimize the expense because I'm good at what I'm doing with the regulations. Then, so no one else is doing this country, so I could charge a higher cost. Everything's with the dollar. Look at the dollar. Everything is a dollar. How much is one? You know, the different scenarios and which one is the best one. And then I'm looking in the future. Remember, so I'm hedging to protect myself, and I'm looking at because who knows what's going to happen in the future? Is it short term or long term? And long term is usually 2 years. The long term used to be 10 years, 15 years. Now it's 2 years. Okay, industry barriers. Okay, local firms may have substantial influence on the government and may use their influence to prevent competition from MMC. That's why an MMC, a lot of times if I'm looking for the marketing strategy or from the production strategy, we'll go in there and open up facilities there. So when they're coming up with a new regulation for new technology, they are part of the design for the regulation. So all other companies coming in there have to at least meet the regulation where you already designed it because your process is part of the development of those regulations and rules. Environmental barriers, you know, China's still a little lax in some of the environmental building codes. You look at the big explosion they had, there's going to be some away because a lot of people died. They can't run like the wild, wild west or the wild, wild China. You have to start have enforcement of these because you have people dying, and a lot of times your own population can say, hey, is it worth the cost? People sick, you know, and you got the illnesses and everything else from pollution, the hospital. So you're saving on one end, but you're paying at the back end. Okay, Bill, and then you have in the reverse. You have right now a lot of the EPA is putting a lot of things on power plants, so increasing the cost. Will that make us competitive in the market or make us less competitive? Sure, environmentally safe, but none of us are working. So after a while, you're going to go back to the extremes. You have to find that balance and not go over there too much and work at that end. Okay. So building codes, disposable production of waste materials, pollution. In some countries are a lot less restrictive than others. Okay, and the regulatory and the ethical differences we have. Okay, let's see. Each country enforces its own pertaining to taxes, currencies convertibility. You know which currencies are allowed to be in the open market, or you have a black market. You also had the bitcoins come in, and there's a whole new way of operating. Right, employees remittance, employees rights, and other policies that you have to operate and what your parent country says. Even though here's the rules here, you can't have child labor there, even though it's legal in that country for that age. Here it's looked at as unethical, unlegal, so you have to follow the rules here. So there's a lot going on here internationally, but it's profitable. Remember all that. Everything has got a cost to it, and which countries I can minimize the cost, or which countries are more favorable for my industry, and which countries I got breaks. So if I'm there 10 years, and then afterwards, do I just close up and leave, and somebody else will come in, hopefully, okay? Or they enhance me to stay longer. Ethical differences, a business practice that is perceived to be unethical in one country may be ethical in another, and sometimes I'm looking at payoffs or greasing to get things done. Is it a payoff, or are you paying a premium? Look at the mail. I could get it mailed for $4.99. Regular post office. I want it tomorrow exactly. Then I'm paying $30. Is that paying them off, or is that just giving me additional service for additional cost? Fine line when I'm doing international, fine line when I'm doing it with my agent. So you have to look at that, because what could be ethical in one may be unethical in another, and that's just one. Abortion may be ethical, is legal here, but it may not be legal in another country. And so I have to look at what I'm offering if I'm a healthcare provider doing globally. Okay, government imposed conditions to engage in direct foreign investment. Some governments allow international acquisitions, but impose special requirements in MMCs. Okay, and that desire to acquire local form. So there's a lot of rules on here. Okay, so we did pretty good. Okay, I'm almost done. Let's look at the summary. MNCs may be motivated to initiate direct foreign investments. One, in order to attract new sources of demand. That's what I'm doing for direct foreign investment. Or to enter markets where superior profits are possible, and I want to be part of the whole thing in there. These two motives are normally based on opportunities to generate more revenue in foreign market. I've got to expand my market. I'm going to come in here. That's why everyone's going to China. Even all the rules, there's a million plus individual. That's why everyone's in India. 1.5 billion, a million. I mean, 1.5 billion in China, 1.5 billion in India. Two large markets. It's open up in there. I have to just different logistics. They have different ways of transportation, different ways of packaging. Once I adjust that and look at my cost saving, is it practical? And a lot of times it is. Other motives for using direct foreign investments are typically related to cost, efficiency, such as using foreign factors of production. Remember, you had the 5 foreign, technology, labor, land, with different skills that are on there that you learn in economics. Raw materials, what's out there, or sovereign wealth. A lot of China's doing it, buying up a lot of that, or technology. MMCs may engage in direct foreign investments to protect the foreign market share. So react to exchange rate movements, so they're moving in there to protect their own market share, to avoid trade restrictions. Some already in their building, so how could you restrict me if I'm part of your local economy? Remember? And international diversification is basically is a common motive for direct foreign investments. Second, allows MMC to reduce its exposure to domestic economic conditions. In case you get a question, a short essay question. Call out stabilized cash flows. In this way, MMC, add to dictionary, may be able to stabilize its cash flows and reduce its risk, such as global desire is desirable because it may reduce the firm's cost of financing. Okay, international projects, why would I want to do that? May allow MMCs to achieve lower risk than is possible from only domestic projects without reducing their expected returns. That's why I open up a foreign direct investment. I'm building up my distribution or my center at that location, or my operations or my sales or whatever, or use just that as a financial background, or I open up my the headquarters in that country because of lower tax rates, more flexibility, what they call inversions here. We're leaving here and open up another one. I'm doing an alliance, a merger. Okay, now this one here, call out international diversification, trends to be better able to reduce risk when direct foreign investments target to countries whose economies are somewhat unrelated to MMC's home country. You want to have an economy, and this is like hedging. Again, everything that you're looking through this whole chapter is hedging. How do I buy in the future, and how do I protect myself? Not to make as much money, some money, abnormal profit, abnormal losses. What I want to do is make a little money, but most of all, that I have the right amount of money at the right time with some left over for spending. Okay? I think it froze up on me. I got a lot of information here, and I'm pushing the system on here. All right, so let's see. We have this in here. Let me just close this all off. Expand to one level. Okay, so we covered a lot of information in this chapter. This chapter was, just some math problems you can be doing, but this is just why do I want to do the direct foreign investment. Utilize this chapter here for your major project. You're going to be open up an MMC, one of the subsidiary someplace. You're going to tell me why you're going to do it, how you're going to fund this, how you're going to start getting the cash ready to pay for this, how are you going to invest it in, how much money, how you're going to do the funding, and when do you think you're going to need the cash in advance, and you're going to be looking at some of the exchange rates, and you're going to be looking at some of the inflation rates. So, but besides all that, that's the dollar amount. What makes common sense? Hey, here's where the money's at. Here's where the people's at. Here's where the new customers. I need a distribution. It costing me too much to distribute here. And those are the information that you're going to be utilizing when you're looking at why direct foreign investments. And you have to look at the host countries. Which one's going to give me a break? No different than if I'm opening up an operation in Illinois. Illinois got high taxes, and if I want to go to Wisconsin, what's Wisconsin going to give me? Lower taxes, lower this. You got the distribution. You're right next to O'Hare airport, just whatever it is. That's the same thing you're doing in international. You look at the countries. You're looking at the rationale, and does it make sense? And the bottom line is you're looking at different places to move. You're looking at how much it's going to cost me. What's my operating? I got a better deal here, but it's going to cost me more for electricity. I got a better deal here, but it's going to cost me more there. Okay, so again, my name is Dr. George Mochocki. This is Fin225 Chapter 13, Direct Foreign Investments, and I'll see you in the next chapter. So you're taking me online class or face-to-face class. This is a supplement. Try to sign up for my courses, pays for my student loans, pays off my student loan, and this way you get all the information, the material. It'll be easier for you to understand. Here's just a summarization. You've already been exposed to it. It's just as a reminder, summarizing what you should know, and I'll see you in the next class. Thank you very much. Bye.